All right, everybody, welcome back for another deep dive. You are not going to want to miss this one. We are going to be unpacking some major news from the Federal Reserve and figuring out what it all means for the economy.
Oh, yeah, this is a big one.
It is a big one. Get this, the Fed just lowered interest rates again for the second time in just a few weeks.
Wow.
I know, right? We'll be breaking down Chair Powell's statement from his November 7th press conference, pulling out all the important bits, and basically just explaining what it means for your wallet. This is where it gets really interesting.
It really does. You know what's fascinating to me is the power the Federal Reserve, or as most people call it, the Fed, has to influence the U.S. economy. For example, the Federal Open Market Committee, or FOMC, sets interest rates. And that impacts everything from loans and mortgages to business investments and hiring.
Yeah, you're totally right. Powell actually said that the economy is strong overall right now. He pointed to the solid 2.8% GDP growth, which on paper sounds fantastic. But what does it actually mean for people like you and me?
Well, a growing GDP usually signals positive things. Businesses are doing well. There's increased production of goods and services. And potentially more jobs are being created.
Okay, some more jobs.
The hope is that this translates into higher incomes and better economic opportunities for everyone.
That's the hope, for sure. But Powell also mentioned that the housing market isn't doing so hot. So what's going on there?
Yeah, that's a great question, and one we should probably spend a little more time on. As you know, the housing sector is often a leading indicator for the direction of the whole economy. There are a few factors at play here, but one thought is that the previous interest rate hikes made mortgages more expensive, which cooled down the market.
Right.
There's also just general economic uncertainty that might be making people hesitant to buy homes right now.
Yeah.
It's definitely something to keep an eye on.
For sure. And speaking of things to keep an eye on, Powell also talked about the labor market cooling down from being overheated.
Right.
Can you break down what that means exactly?
Of course. An overheated labor market is essentially when there are more jobs available than people looking for work.
Oh, interesting.
This gives workers more leverage to negotiate for higher wages, which on the surface sounds great.
Yeah.
But when wages increase too quickly, it can fuel inflation.
Right. Inflation, the dreaded I word.
Exactly. And inflation, as you know, means a general rise in prices for everything.
Okay, so the Fed is trying to cool things down to keep those prices under control.
Precisely. And that's where those interest rates we talked about earlier come back into play. Raising rates makes it more expensive for businesses to borrow money, which in theory should slow down their hiring and moderate wage growth.
Gotcha. So it sounds like they're trying to walk a really fine line here, but there's something that seems a little counterintuitive to me. Powell mentioned that nominal wage growth has eased, which I thought was a good thing. But at the same time, the unemployment rate is actually higher than it was last year. Shouldn't those two things be moving in opposite directions?
That is a great question. Nominal wage growth, just to clarify, refers to the percentage change in wages without taking inflation into account. And yes, on the surface, it seems counterintuitive that wage growth would slow down while unemployment ticks up. But there are a few nuances in the labor market at play here. Powell specifically mentioned the jobs-to-workers gap narrowing, which indicates that the intense competition for workers we saw earlier this year is starting to ease up.
Okay, so there are still lots of jobs out there.
There are still a lot of open jobs out there, but employers aren't as desperate to hire as they were. So we're not seeing those super high wages being offered just to attract talent anymore.
Gotcha. So if you're job hunting right now, what does this all actually mean for you?
Well, it's kind of a mixed bag, to be honest. The good news is there are still plenty of jobs out there. The maybe not so good news is that the competition for those jobs might be a bit tougher now. And those big salary offers we were seeing might be a thing of the past. The best advice I can give is to do your research, see what's happening in your specific industry, and don't be afraid to negotiate.
That's great advice. Okay, we talk about the economy and the labor market, but there's one more big topic we need to cover: inflation.
All right, the elephant in the room.
The elephant in the room.
Powell said that inflation is down significantly from its peak, but that core inflation remains somewhat elevated, which is Fed speak for we're not out of the woods yet.
Yeah.
To understand what he means by that, we need to look at the difference between total inflation and core inflation.
Okay.
Total inflation, which is measured by something called the PCE price index, includes everything: food, energy, rent, healthcare, you name it. But some of those prices, particularly food and energy, tend to be very volatile.
I see. So the Fed is really watching that core inflation number closely.
They are. Core inflation filters out those more volatile prices to give a more stable picture of broader price trends.
And that number is still a bit high.
Yes, it's currently sitting at 2.7%, which is above the Fed's 2% target.
Okay, that makes sense. So even though we've seen some improvement, the Fed is still, keeping a close eye on things to make sure those underlying price pressures don't get out of control. Now, I have a question about something Powell said. He used this phrase that kind of went over my head. Longer-term inflation expectations appear to remain well anchored. Sounds like good news, but what does that even mean?
Yeah, I'm happy to explain that. So remember how we talked about wages and prices being interconnected? Well, people expect prices to keep going up. They're naturally going to demand higher wages to try to keep up. And that can create a self-fulfilling prophecy, leading to even more inflation. That's the kind of spiral the Fed is really working hard to prevent.
Right, I see.
So when Powell says that inflation expectations are well anchored, it means that people generally trust the Fed to get things under control and believe that inflation will eventually settle back down to that 2% target. And this all ties into consumer confidence. If people feel optimistic about the future, they're more likely to spend and invest, which helps the economy keep moving in the right direction.
So the Fed wants to see people putting their money where their mouth is, so to speak. Not just saying they believe inflation will go down, but actually acting like it.
Exactly. Actions speak louder than words, even in economics.
Okay, so let's talk about the big news of the day. The Fed lowered interest rates.
Yes.
You mentioned it at the top of the show, but can you remind us what that actually means and why they did it?
Absolutely. The Fed lowered its target range for the federal funds rate by 14 of a percentage point, which brings it to 4.12 to 4.34%. This is the key interest rate that banks use to charge each other for overnight loans. And it sets off a chain reaction impacting all kinds of interest rates in the economy.
Okay, so 0.25% doesn't sound like a huge change.
You're right. It's a relatively small adjustment, but it's significant because it shows that the Fed is shifting gears a bit. Powell even said they are recalibrating their policy stance, which basically means they're adjusting their approach based on the latest economic data. They're trying to guide the economy toward a soft landing, keeping growth going without letting inflation get out of hand.
It sounds like a tricky balancing act.
It really is. And Powell made it very clear that the Fed isn't on autopilot here. He specifically said they're not on any preset course and will make decisions on a meeting-by-meeting basis. And that kind of language is very intentional. He's trying to send a message to the markets and to the public that the Fed is being thoughtful and responsive, not just sticking to a rigid plan no matter what.
Right.
They're going to keep a close eye on things and make adjustments as needed.
So what are the key things they'll be watching for over the next few months, and what could that mean for future interest rate decisions?
Oh, you guessed it. Inflation in the labor market will be front and center. If the economy keeps growing at a solid pace and inflation starts to creep back up, the Fed might hit the brakes on these rate cuts or even pause them altogether.
Okay.
On the other hand, if things start to wobble, maybe the labor market weakens or inflation takes a sudden dip, they might decide to lower rates even more aggressively to try to stimulate things.
So they're constantly evaluating and adapting their strategy. It really all comes back to the Fed's dual mandate, right?
Exactly.
Yeah.
Their mission, as you know, is to promote maximum employment and price stability. Sometimes those two goals can feel a bit at odds with each other. Imagine you're walking a tightrope. Lean too far to one side and you're going to lose your balance.
Right.
The Fed's job is to find that sweet spot where the economy can grow. People have jobs, and prices stay relatively stable.
And it's easy to think of the Fed as this far-off entity that doesn't really have much to do with our daily lives. But that's not true at all, is it?
Definitely not. The Fed's decisions have a ripple effect across the entire economy. Think about it. When interest rates go down, it becomes less expensive to borrow money for things like mortgages, which can make it easier to buy a home. It can also make it more appealing for businesses to invest and expand. But on the flip side, lower rates can also lead to lower returns on your savings. Everything is connected.
It really is. Speaking of connections, Powell's statement actually highlighted a fascinating one between housing and the job market.
Oh, that's interesting. What did he say?
He pointed out that the slowdown in residential construction is actually contributing to the easing we've seen in the labor market.
That makes a lot of sense. Construction is a major industry, and when activity in that sector slows, it can impact employment across the board. So the weakness in housing could be putting some downward pressure on wages, even as the overall economy remains relatively strong.
Yeah, that's a great example of how seemingly unrelated sectors of the economy can actually be quite intertwined. And it highlights why it's so important to pay attention to all of these factors, not just the ones that seem directly related to our own personal finances.
Absolutely. And that brings us back to the importance of what the Fed is trying to do. Their policies are designed to influence these interconnected systems
Right.
and steer the economy toward a path of sustainable growth.
Yeah, it really is fascinating how all these pieces fit together. So if we pull back and look at the big picture, what are the key takeaways from Powell's statement?
I'd say the main takeaway is that the U.S. economy is in a pretty good place overall, with solid GDP growth
Yeah.
and an easing labor market that's hopefully helping to keep inflation under control. However, there are a few potential trouble spots like the housing market that we need to keep an eye on.
Right, and the Fed is definitely sending message that they're proceeding cautiously, but they're not on autopilot. They're going to be watching the data closely and making adjustments to interest rates as needed.
Exactly. And that brings us to something I think is worth pondering. If the economy continues on this trajectory, with growth holding steady and inflation hovering above that 2% target,
Yeah.
what might the Fed do next?
That is a great question. Will they continue to lower rates, hold steady, or maybe even, dare I say, raise rates again?
It's hard to say for sure, of course.
Yeah.
The economic landscape is constantly shifting, but I think Powell's emphasis on data dependence and flexibility gives us a clue. They're going to be laser focused on those key indicators we talked about, inflation, the labor market, and housing, and they won't hesitate to change course if the data suggests it's necessary.
So the takeaway for our listeners is that the future is uncertain. But by understanding how these different forces interact and paying attention to what the Fed is doing and saying, they can be as prepared as possible for whatever comes next.
Absolutely. Knowledge is power, as they say.
Couldn't agree more. Well, I think that about wraps things up for this deep dive. As always, thanks so much for sharing your insights.
My pleasure. Always happy to geek out about economics.
And to our listeners, I hope you found this deep dive insightful and engaging. Remember, even though the world of economics and finance can seem complex, it's actually full of fascinating stories and insights that can have a big impact on your life. Until next time, stay curious.